So, to our point, lots of disruption in this space. AI and the Mag 7 have really carried the stock market, the US stock market, these last couple of years. We know that they are responsible for a disproportionate amount of market cap within the S&P 500. And we think that that makes general markets extremely vulnerable to whatever happens to the Mag 7, to the stock market leaders of the last couple of years. So, when you've got market breadth and all companies are kind of sharing in this massive market trend, we actually have the opposite, a very narrow market where it's just these few that are kind of carrying everybody up. But we know that they could do that both to the upside and the downside. So what we could see here is some kind of domino effect that could lead to a larger market sell-off, and then we'll get, again, what I'm calling the capital rotation event, which would be a flight to safety and into the safe haven assets like gold and silver. And so if we kind of go to the next slide here, what I've got here, we may just need to move our screens over if we can. If not, that's okay. But what this slide shows, thank you very much, is that blue line is the market cap of the Mag 7. So the Magnificent 7, that's Apple, Amazon, Meta or Facebook, Microsoft, Nvidia, and Tesla. These guys account for nearly 60% of the market cap. That's the S&P growth, pardon me. So the blue line is S&P growth. So they have contributed to 60% of the S&P 500's growth over the last several years. And so that red line below is their market cap. Those 7 stocks account for just a little over 30% of the entire index.
Has that ever happened before, Micah?
So to this scale, where again there's so few stocks that are carrying the rest of the market, no. Of course, in the 60s you had the Nifty 50. I'm sure you've heard of that, and a lot of our clients have, where you just bought the Nifty 50 and you'd do fine. Well, same thing. You buy the Mag 7 these last couple of years and you'll do great. But it is somewhat reminiscent of even the kind of 95 to 2000 .com bubble, where you just had this mania in a new sector. The internet was going to change the world, and of course it did, but it didn't right away in the year 2000, right? And just like with AI, very disruptive, will change the landscape of our world, increase productivity and all these things. But right now, is that going to be where we see all the kind of benefits manifest? I think it's probably going to look a lot like a .com bubble once we're on the other side of it. And of course, hindsight will be retrospective, but these things could keep going for another while. I think maybe weeks, months, maybe quarters at most. But the purpose of this chart was just to show you how disproportionate the market growth and market cap are in the S&P 500 amongst these just 7 stocks.
I will say something that's interesting too, is that I think as someone that gets investment opportunities presented to them all the time, that over the last 5 to 7 years, it was blockchain opportunities, venture capital, blockchain. It shifted when a lot of those opportunities proved to not be, successful, shifted immediately to AI opportunities, meaning all these AI opportunities to invest venture capital money. And the thing that you realize is that a lot of times, a lot of it is just raising money. They're just raising money in a sector, and smart money is like, they see a catchword, they jump on, and now AI. And there will be massive amounts of losers in AI. And that people need to keep that in mind, is that not all investment in a category will win. And there will be so many losers that are happening. And so that's what DeepSeek sort of proved, right?
Exactly.
That you don't always need to spend as much. And so people need to be careful when they look at these things, as they see these, oh, well, I want to be an AI. It's a, $15 trillion potential industry. I want to be there. But a lot of it is the raising of money, selling of money, all this venture capital. When the Nifty 50 ran, there was no venture capital, right? I mean, these ideas, these firms that come out are just raising money for areas because they make money on the raise. They don't
Yeah,
have to prove the product.
exactly.
And that's a new world. So anyways, I did want to mention that for me as an investor, an accredited investor, I get these calls, blockchain,
Yeah.
now it's AI, and then there'll be another thing in about a year that they'll try to sell me.
Exactly. So we can move on from this. I want to drill down a little bit, obviously, into DeepSeek and the competitive advantage that they've shown. It's had a direct effect on NVIDIA. So this was NVIDIA at yesterday's close. Of course, you mentioned earlier, Colin, that it did, it's popped today. It's up 5% or so. So maybe that's a dead cat bounce. I think it was quite oversold, but we do still need to see these things resolve. You don't go straight up. You don't go straight down. You're going to have kind of little bounces along the way, but a fairly significant drawdown yesterday. And I'd like to go to the next slide, which again kind of drills down specifically into NVIDIA. It just shows you that this is a trend line that's been respected for over 15 years at this, or sorry, 10 years at this point. And NVIDIA has, within this upward channel, it shows us that we're in an upward trend. It has, again, along the way, hit the top line, which is the resistance, and then it's come down to test that bottom line, which is support. So we've got multi-year resistance, multi-year support, and we've been more or less respecting the parameters of this channel. But in 2024, we had a breakout of resistance. And when you break resistance, of course, you tend to put in a fairly significant move to the upside. But we see it now coming back into that channel, and we're at this really interesting place where we could actually see the beginning of a move toward the major support line, the bottom portion of this channel. And just as a little too small for us to see right here, but a revisit of the bottom part of that trend line effectively is a 75% drawdown.
75%?
It's a 75% drawdown in the price of NVIDIA. Now that is kind of, again, reminiscent of Cisco losing 90% of its stock value, Amazon losing 90% of its stock value in the post-2000 dot-com bubble. So again, no crystal ball here, and this may materialize to correction and a retest of that support line, the bottom of that trend line, over the next couple months, maybe the next year or two. We won't know when, but we do know that we're in a massive bubble. U.S. tech stocks are, some of the most richly valued stocks we've ever seen in any cycle. And again, hindsight will be 2020, but this kind of has trouble written all over it. So if we're simply going to retest the bottom of that upward trend line, it's a 75% correction in one stock, but as you pointed out, disproportionate amount of weighting in a U.S. stock market indice means that the NASDAQ and the S&P would be in for a major correction if we are going to see a retest of that bottom trend line. So I think it's just interesting to keep in mind how vulnerable the whole space is based on the performance of just a few stocks. Stock market valuations at record highs is the best time for our clients to crystallize that wealth, to crystallize the value of their retirement accounts in physical metal. Don't wait for the 20% drawdown. Don't wait for the NASDAQ to blow up. At that point, you're buying gold at a much higher price, and you're doing it with less money in your portfolio. So we're not saying roll it all into gold, but we're saying this is a perfect time where the stock market could continue higher for some time, but you're risking a lot kind of at the 11th hour. So it's a great time to be crystallizing or locking in the value of your retirement account with gold.
Absolutely. Yeah. Question for you, Micah, from the audience, from Marita. Will tariffs on copper drive the price up? She wants to know.
I think it will. Of course, copper is an industrial metal, not one that we deal in here at Noble Gold Investments. We're focused on precious metals, but there's a lot of unknowns with respect to tariffs. We will see dramatic increases if it's across the board, right? If we see industrial metals whacked with a 25% or more tariff, it'll certainly have an impact on the price. Now, mind you, copper's, they call it Dr. Copper, can be a bit of a recession indicator. If we do end up in a recession, the price of copper could drop. But the price of copper going up, which it seems to have been the last little while, is also indicative of inflation. So it's an interesting commodity to monitor. And I think that we'll find out more in the coming days. We're not too far off from when some tariffs are supposed to be coming into effect here. So we'll certainly find out more. Thanks for the question.
Great. Yeah. Great. Yeah, that was the one question that she had about copper.
Great.
All right.
We can, sorry, Colin, we can move on just to my next slide, which sort of goes to my point and Charlie saying what a great time it is to actually take some of those major gains that our 401k and IRA clients have seen over the last few years, crystallize and lock those gains in with physical metals before a capital rotation event. And I do think we have a capital rotation event on the horizon. Just to kind of put it into context and perspective, a capital rotation event would be like a dot-com bust of 2000. It would be like a global financial crisis of 2008, where the aftermath essentially has precious metals in a multi-year bull market, and where you can actually see multi-year bear markets in stocks. And so when capital decides to exit these overvalued sectors, whether that's kind of reactively in a crash or proactively, which would be preferable, they're trying to find safety and they're trying to find value. So they're going to be leaving these overvalued sectors to find what's cheap. And frankly, gold and silver are extremely cheap, provided with the risk that we actually have out there in the world and in the market. So capital rotation event is a huge, it sends us into a huge multi-year bull market for precious metals, and could also mean a multi-year bear market for stocks, and just sort of kicks off general volatility for the stock market as well.
Yeah. And I always, one thing to talk about too is that people, wealth isn't gone. It's just moved, right? It just moves to a different place.
Right.
And smart investors see those opportunities. And it looks like wealth is gone. And for people that are stuck there or have to sell in those down markets, the wealth is gone. But for people that see opportunities, there's actually a lot of wealth created in these capital movements. And you're talking about 2000 and 2008. I mean, these are pretty big time. 2022, there was some capital movement that happened there.
Exactly.
Bear markets. So
yeah.
And obviously we know the number one thing is bear markets are much faster than bull markets.
Exactly.
They happen much quicker.
Especially if we have that added element of increased volatility, which I've got a couple slides on coming up here. So
let's get into that.
So if we kind of move into the next one here, stock market volatility, just to frame it for our clients, those that aren't familiar with that term, volatility is really the degree or variation of change in the price of financial assets or markets. And in other words, it just means like how quickly can the price go up or go down. So higher volatility means that we've got sharper, more unpredictable price swings, whereas low volatility means that we're in more stable, kind of gradual changes. And that's certainly been, we're coming out of a relatively low volatility period. And I think we're coming into, and there are many people talking about this, saying that 2025 and onward will actually be a period of extraordinarily high volatility. And I've got an interesting chart on the next slide that shows you kind of where we're at, uses a little bit of technical analysis. This is really simple stuff, but it looks complicated. So I'll just walk you through what this is. One of the measurements of volatility is an ETF called UVXY or UVXY. And the long and short of it is it kind of shows us a put-call ratio. But the higher these prices spike, and it's not really a price, it's again just a measurement of volatility, that's when you're getting a dramatic change in the stock market. And so down below in white in that quadrant, I've shown you something that's called a downward wedge. And this is a technical analysis formation that typically resolves to the upside once you make your way toward the apex or the kind of tip of the triangle. And you can see a clear kind of downward wedge, falling wedge pattern here in UVIXI. Now, this is from August to now. If you look on the sort of far left side where you've got that little volcanic eruption toward the taller part of the triangle, that was the volatility that we saw in August. So in August, Colin, you'll remember on the 31st of July, we had a Fed decision, or a Fed rate decision, Fed funds rate decision to hold. And that actually shocked the stock market. They were expecting cuts. They were expecting easier money. And the fact that they didn't get that at a time that it was expected sent it down about 5% in just a couple of days. It was actually less than a week. But so a small 5% change in a short period of time in the stock market can actually spike volatility. And the formation that we're making now, this falling wedge pattern, is eerily similar to what we had in early 2020. Now, 5 years ago, at around this time, Colin, you'll remember, it was COVID. COVID shocked the world in January, February, and it shocked the markets in February and March. And what I think we're seeing now could be something very similar to what we saw back in 2020. And if we go to the next slide, we'll see how that turned out. So when we got into the apex of the falling pennant formation in 2020, we didn't know what the catalyst would necessarily be, but COVID is what actually allowed the markets to erupt. What we had then was obviously global lockdowns. It was a global pandemic that crashed the stock market by about 20% in little less than 3 weeks. We saw extreme volatility during this time. The metals were hit very briefly, very temporarily, because when we have these major liquidations, gold and silver are viewed as tier one liquid assets, and they're often sold to get the cash to kind of save yourself, save your shirt, save your portfolio from margin calls and these other things that were happening. But what happened after this volatility spiked was the summer of 2020 rally in the metals, where gold went from 1,500 to 2,000, and silver went from $11 to 30 in a matter of months. And so,
yeah, it was. And by the way, that pullback happened in end of 2008 in the gold and silver market too. The same exact thing. It was a liquidity crunch. They got cash, and then the Fed came in and announced quantitative easing, which is what I think they're going to do again. And they flooded the market with cash. And from 2008 to 2011, gold and silver went on a massive run because they were just printing money, and they opened up the money supply, which I think they're going to do again, because they've been very tight for the last few years because they're worried about inflation. And the dollar has gotten very strong. And, that bodes well for certain things, but it also makes it very difficult for us because we are borrowing some of that money. Also, it makes things quite expensive. We're trying to sell goods overseas. Now they're more expensive because our dollar is so strong. And I think that if the Fed can't lower rates, then I think they're gonna look to do a QE push.
And we're going to talk about that coming up here really shortly. But I agree with you, Colin. I think, when things look similar, it doesn't mean they're going to go the same way. But the reaction that we had in 2008, in 2020, where markets pull back, so do the metals very briefly. But then what I've sort of, am defining as capital rotation event, in that fear, in that volatility, all of that money that's either in the markets or in cash will then fly into the safe haven assets like gold and silver. And that's when they go on a multi-year run. So if, we want to talk about a couple of things outside of NVIDIA and the kind of tech stock market vulnerability, there are a few other things I think that could, provide us with catalysts for a market crash here in the coming days, weeks, months, who knows.